All right, guys, we are back for another Hustle podcast episode. And today we have a guest, Ted Thatcher with Pine Brook Financial Group. And we're really excited because one, you're our first guest. So thanks so much for being on the podcast. And two, we're really going to be diving into different strategies of ways to kind of build passive income, kind of hear your background of how you see money, how you see wealth, how you see, investing. So maybe give everybody a background, like what you do at your firm, you own it. So you get to kind of start us off.
No pressure.
No pressure. My name's Ted Thatcher.
Yeah, exactly. Well, Faith, obviously it's a pleasure to be with you.
Yes.
What we do at Pine Brook is we help families retire confidently. And our whole entire firm is really focused around specifically retirement planning. And we really typically help folks that are sort of near or in retirement. And what I want to get to share today is, a breakdown of maybe somebody who maybe is a little bit earlier on in the journey. You asked to talk about that. We can dive in there. And, obviously it's an exciting journey to start a business and to grow. And we've seen a whole lot of that, especially the last 5 years or so, which has been a blast.
Right. Did you always grow up in this background, like having this kind of lifestyle? I actually really don't know. Did your family kind of inspire you? What kind of inspired you to be in this role?
That's a great question. So very, very little of my family is in finance at all. Most of my family, my extended family anyway, is farmers in the Midwest.
Okay.
And so outside of hearing about the term yield as far as crops.
We're not talking about the cornrows.
Yeah, exactly. Didn't have a whole lot of, I guess, natural financial direction growing up. I was very grateful to be around people that all started businesses and worked for themselves. Most of the environment I grew up on was a family farm.
Okay.
So there's a 5th generation family grain farm that my family has run. And so
Wow.
I tell a story a lot to our clients and when we do events just about how I really got started in the space. And, specifically, just these struggles that some members of my family have gone through when it comes to, preparing for their own financial future.
Right.
And so, when you kind of grow up with those types of experiences, it gives you sort of a passion to sort of see the other side of that coin. And so, we work with a lot of business owners just in general too. And while building a business is super exciting, sometimes it's hard to figure out what you do with, that profit of that business.
Right.
And, what it kind of comes down to, in my opinion, is everybody ought to have some kind of wealth strategy for their family. I know you guys focus so much on real estate.
Yep.
We do a whole lot in the financial markets. I really don't believe that there's any right or wrong there. I think it's just more of, what do you feel comfortable with? What do you know? I'm a big believer that you want to invest in what you know.
Yep.
And I would tell anybody listening, when you invest in what you know, you want to be thoughtful about not trying to get too worried about getting your wealth done in the short term. You know,
it's the long term.
Exactly. And it's so easy to say that. A lot of people say that. But not nearly enough folks really are patient enough to put it into practice.
Yeah.
I mean, you've started a business, how hard it is to get that sort of momentum going.
Yeah, I remember I was actually telling one of my mentors, I was like, I would always for every single year, go I just had a really good year. I don't know if next year is going to be the same way. And it's just like you were saying, it's this long term, you build it, you let it grow, you water the crops, not to bring back the farming, you water the crops and, you let it kind of mature over time. And I think for your strategy, correct me if I'm wrong, you are kind of building your blocks to have more of a long-term nurture and play versus the short-term win. In our books, that's kind of more buy investment properties, hold it, have rentals, versus the short-term win would be buy a property, flip it, and, move that money to somewhere else, kind of thing. Absolutely.
So I think one person's name that always comes to my mind when I think about this is a guy named Rick Guerin. If you're not familiar with Rick's name, he was
I'll
the
divert that to Dylan.
yeah. he may be Flora. But he is the third partner at Berkshire Hathaway, who is no longer a partner. So he started with Warren Buffett and Charlie Munger when they began Berkshire. And well, of course, Warren is a big, long-term investor, right? He's in his 90s and still says, we're thinking about the long term. You know, like, guy, man, there's no
90.
long term for you.
You got like 10 years left.
But, you know, of course, Warren and Charlie have always said, you know, kind of get rich slow. And I think that is exactly the point we're getting at here. And so Rick, back in the early 70s, ended up leaving Berkshire because of all the volatility in the financial markets. And really, he was forced to do so because he had been investing and trying to get rich really fast.
Right.
He was buying stocks with a whole lot of margin debt. And so when the volatility hit, he got washed out. Basically, he had margin calls, he got washed out, and he ended up selling all of his Berkshire Hathaway stock to Warren for pennies on the dollar. And, you know, of course, now Berkshire Hathaway stock is worth, hundreds of thousands of dollars or whatever it is today.
Right.
And so I just think I'm going to get a big picture probably and put it up in my office of Rick's face. Don't be like Rick.
Yeah.
But you can apply that to anything. And so, you know, you have to be thoughtful about, you know, I think that perspective. To me, that's just a great story and a really inspiring one when we just get reminded to do things and be patient with them, especially when it comes to wealth building. And so, you know, a core tenet that I really, you know, emphasize with folks, especially that are just starting their wealth building journey, is to, you know, operate with good financial principles, live on less than you make, right? Whether that's investing in real estate or the financial markets. And, you know, I try to tell folks aspirationally, try to invest 20-25% of your income. And so the focus there isn't so much on trying to find the perfect investment. It's focusing on your savings rate.
Yeah.
I was actually talking with a real estate investor in our community not too long ago, and he had shared, you know, a story about his dad, who has gone through a lot of ups and downs. He was in real estate as well. And he said he's watched people time and time again invest in real estate, you know, take some of their income, invest it, but not have enough cash. And so every time there's a market cycle, whether it's a 2008, 2009, or what we've gone through with COVID or interest rate hikes the last 18 months, you kind of seem to give all your profits back.
Yeah.
And the same thing happens with folks in the financial markets because literally, Nick Murray talks about this a lot, but over 80% of real returns experienced by investors are determined not by the investment itself, but by investor behavior.
Yeah.
So, you know, basically making super emotional decisions and selling at an inopportune time when, you know, whether it's investing in the financial markets or real estate.
Right.
And so, you know, kind of coming back to my, you know, earlier point though, if you can focus on, you know, trying to increase your income and trying to keep a really good savings rate, that is going to give you the flexibility to actually be able to build wealth. Yeah, to build wealth and to be able to take that patient approach, which is what every truly wealthy person that, you know, I certainly look up to has decided to do.
I think I heard it like one of our mentors, like, you know, for real estate, obviously we get more of like a commission check. So it can be something like of a larger scale for some people that, you know, have like an 8-to-5 job or something like that. And like his mindset was around like you have just the average people that make this amount of income underneath this percentage. Then you have like this wealthy person, then you have the rich people. And the more so wasn't so much the number behind it. It was like how people actually see the like paycheck, meaning if you're like underneath this percentage, you maybe see the commission check and you just cash it into your savings account and you just live off of it and you think you're really rich. And then as it kind of grows into like the different categories, it's like wealthy people see an $8,000 check, let's just say, and they start dividing it, like you're saying, into like a savings account, into putting it back into the business or reinvesting it. So it's not just $8,000 whole. It's, you know, oh, actually it's $1,000 towards my retirement account. And then how does that trickle into like more, you know, accounts? And I think money as a whole, like, you know, it's interesting where like our economy, obviously things have risen in price and everything like that. And I know people feel that squeeze of like, how do I save when everything's so expensive? And I think like a couple episodes prior, when we first kind of launched it, and Dylan and I were talking, it's just the idea for us, like we have like the mindset around like living, like you said, living within your means, but like focusing like what's the long-term play? Is it saving like to get to this point to invest in here? Or is it like, you know, I want to just live paycheck to paycheck, which some people are totally comfortable with, you know? And I think it's first, I think it's first like understanding your mindset behind what money means to you, and how that money gives you the wealth to like want to actually have the desire to invest, build passive income, build a business, you know, put in a, market or real estate, however that looks like for you. I think it first starts with like a mindset of that, of understanding. So would you say like your background with like growing up with your family and like the farm industry, obviously that's very separate, like what you're doing now, you
totally.
know, did you ever have a farm?
Not personally, no. Although I've driven a lot of tractors in my life.
Do you ever desire to have a farm?
If I told my wife we were going to start homesteading, I think she would probably get out a bat and start hitting me. No, it's not. It's I guess I have a tremendous respect for it. Super grateful to grow up in that environment, but not exactly for me.
Yeah. So with that being said, like your background and kind of pushing into wealth, how would you tell somebody, like somebody walks in, they just like the idea and concept of, you know, hey, I want to build something over time, but my mindset has never saw money that way. Like how would you tell somebody to start posturing their mindset for that?
Yeah. So we can get super tactical for a minute. So when I say, hey, save and invest 20-25% of your income, a lot of people out there are like, Ted, you sound crazy. You know, that's like super impossible for me. And especially, young folks, you're earlier on in your career, you're not earning as much potentially. As you even exit your 20s, a lot of people are starting families. You got to buy the house. You got to...
The American dream.
Yeah, well, exactly. The white picket fence. You have a couple kids, and all of a sudden, every time you turn around, you need to buy new diapers, new clothes. You got to buy a crib, or there's a thousand things pulling at your wallet, and so you're kind of in that that messy middle of life, and so trying to invest 25% of your income, you're like, dude, what are you smoking? Yeah. And so everybody just has to start somewhere. And that's why I do like the financial market so much, because it keeps things really simple. And obviously, when you invest in securities in the stock market, you can get really complicated really fast. But I don't really think that that's the way it ought to be done, especially when you're starting. You want to keep things as simple as possible. And I would say, in that sense, building wealth is simple. However, it's very hard to do, right? The discipline to actually do it is really hard to do. And so I think that the first step is, the methodology I really believe in is using index fund investing. I know Dylan and I have even talked about that a little bit in the past. And if you're unfamiliar with what index fund investing really looks like.
Like I'm 3.
Yeah. So a lot of people have heard about like what a mutual fund is, right? And so a mutual fund is basically just a basket of investments, right? Whether that's stocks or bonds, and they were really common. Well, they're really common today, but just in general, especially in the 80s and 90s, mutual funds really kind of had a fever pitch. And if you're older listening to this, you probably remember like Fidelity's Magellan funds and Peter Lynch and, driving great returns. But the problem with a lot of mutual funds is they have pretty high internal cost, pretty high fees. The fund fees that exist in those kind of investments can be 1 or 1.5% in some cases. And so essentially a guy by the name of John Bogle, or Jack Bogle, he went by Jack Bogle his whole life, started a tiny little company called Vanguard, if you've ever heard of Vanguard. And he created what are called index funds. And it drove essentially the cost of owning a mutual fund from that higher rate all the way down to basically nothing. And index funds today can cost as little as actually zero. Fidelity Investments, I believe, has zero cost funds for their clients. And but even still, most index funds cost almost nothing, 0.04% or 0.05%. And when you can simplify
Right.
investing down to something as simple as, how much can I save? How much can I invest every month? And I mean, literally pretty much just focus on that. As long as you have the right mix of funds, that means you need to only think about one thing and just focus on the discipline is my point there. And, for somebody early on in their savings journey, the big three, the largest providers of index funds right now are Vanguard Investments, Fidelity Investments, and Charles Schwab. And I'm a big believer too in kind of using a little bit of a glide path as far as risk goes over the course of time. And so if you're looking for a place to start for anyone that's, thinking about investing in their 401k even, a lot of 401ks have offerings of index target retirement funds. So that aren't the mutual fund version of of a target date fund, but the indexed variety. And basically that gives you a glide path for all the allocation. You don't need to think about what choices to make.
Put it in, and
you just, it's a target date, right? So you choose, hey, what date in the future might I want to retire?
Yep.
So you just say how much
tomorrow.
Yeah, exactly. Yeah, of course. But it's just how much can I save, and then when am I going to retire in the future? When am I going to start to use the money? And until you reach, I would say a net worth of, having about 100,000. 250,000 invested in a financial account, using that methodology is perfectly fine. It keeps things simple. It keeps things low cost. You can do it yourself. You can use that same methodology to invest in finance for your kids, college. So a lot of people we talk to are trying to do that. But at least it gives you a place to start.
Totally.
Some people want to even go simpler than that and just invest in the S&P 500, the 500 largest companies in the United States. Other people like total market indexes. There's a lot of options. Again, you could kind of go to those big three providers, and that's a good place to start. But if you can't do 20 or 25% to start out, you're in good company. Most people can't do that.
Right.
It's just, start your wealth building journey somewhere. Let that compounding start to work for you. You put even $50 a month away, and you just start to kind of go blind to that money leaving your account every month, then, maybe in a couple months you could increase it to 75.
Yeah, I always tell people for buying real estate, same way, people are like, oh, I'm renting at $900, and I'm like, well, unless you're putting a lot down, $900 is not going to be achievable as a realistic mortgage payment. So I say hey, you should start living like you're basically paying a mortgage. So if it's $1,800, start paying a couple months at $1,800 and see if you can do it. And if you can't, then, maybe figure out what costs are, frivolous stuff that you could cut, or, where you could add income, or, save more so that you can have more down to keep that payment lower. But I think it's the same thing, like you're saying, start somewhere, see wealth and see savings, in a way that gives you kind of whether it's not 25% or if it's the $50 method strategy. I think for some people it's just really understanding what am I trying to achieve at the end of the day? And that's the same thing we do with real estate. It's if you're buying, why are you buying? Is it because you're needing
purpose.
A place to live, purpose? Are you trying to invest in this? Is it going to be a rental down the road?
Yeah.
And I think that really kind of sets people up. So wealth mindset. I know we have a lot of more tactics to kind of deep dive through. What would you say is the second? So I come to you and I say, yep, I can do 20 to 30%. Yep, I can start doing that. How long? Obviously, would you say start right away, or is it kind of get kind of a nest egg built up so you can kind of feel that comfortably? Do I have to invest all the time? What's kind of the practical more strategy of the, I guess, time frame of it?
Yeah. So, I mean, whether you use any of the kind of specific funds we were just talking about, obviously the best time to start investing, most people would tell you, is yesterday. And the second best time to do it is today. And so, if you're ready to get started, you can, if somebody came into our office, we'd probably just open up an investment account for them. Maybe an IRA, probably. If you're younger, a Roth IRA makes a lot of sense. There's a lot of tax advantages to a Roth IRA. It grows tax-free. Or just a traditional brokerage account. So before in retirement accounts were ever sort of designated by the government as having tax incentives, people just invested money in a stock account, in a brokerage account. And, for a lot of your audience, I imagine, they're thinking, hey, I don't want to just invest only in my 401k that I can't touch without penalties until I'm 59 and a half years old.
Right.
And so having a real conversation, not just about what we were talking about before, which is asset allocation, like how do I invest this money, but also asset location, where you invest the money is like, at least to me, a premier talking point when it comes to how you think about your investments, because it has everything to do with the amount of flexibility you're going to have when you go to pull them out, what you use them for. You mentioned, hey, if I was going to try to do a mixture of both, like at some point, if I wanted to take some money out and invest in real estate, if you're going to do that at, in your 30s or 40s, you probably don't want to use a traditional retirement account for those investments.
Yeah.
There's just a lot of, you're costing yourself that when it comes to the tax side of things and just penalties in general. And so, and obviously I'm not the first person to talk about that. That's
Totally.
I think even Dave Ramsey talks about that. He basically parks a ton of money in the S&P 500 from what I understand. And then anytime he wants to buy a piece of real estate, he just goes and pulls from that and then, makes his purchase. And so asset location, I don't think, this is sort of a sidebar, but you hear a lot of financial advisors talk about asset allocation. But in my opinion anyway, not nearly enough for having that conversation about really asset location as well. And so the flexibility there. I don't know if that fully answered the first part of your question.
No, it did. It kind of like correlates with real estate too. It's like when you buy something, it's like, where are you buying and why are you buying here? And like, what's the long-term goal? Like to hold it, rent it, or, what's the end goal for it to offload it or keep it, So I think that's like a huge part, because I think people are like, well, I'll just throw some money into an account. But then it's just like, okay, that's great. Like that's step one. You got the savings, you're able to do that. Now step two is like, what's actually the driving practice. And I know that for us, we've changed our accounts, like as our goals have changed, we've closed accounts and moved it to somewhere else so that it's like, we're maximizing as much as possible. If Dylan was here, he would talk way more. I'm just like, okay, let me just pretend like I know what we're doing. But I think, knowing that. So I really think if somebody was trying to save, then figure out the location, I think for a lot of like our audience, they're younger. And so kind of just wrapping around their mindset, what would you say like a really good person to like listen to kind of like be inspired by wealth and that mindset?
So I'll rattle off a few books. I have like a small library in my office. There's a really easy read from Tony Robbins actually called Unshakable. It goes through a ton of the principles and that I was just talking about before. Really, really great starting point. Easy read. It's a couple hundred pages. You could pick that up. If you're kind of more the story type, there's a great book called The Richest Man in Babylon or The Wealthy Barber. Those were written, some time ago, especially The Wealthy Barber. A lot of people had pensions back then, but really, really good principles. And even I think it's Morgan Stanley's book, not Morgan Stanley, Andy Stanley's book, The Millionaire Next Door. Just outstanding principles for taking a normal American situation, a hardworking American situation, and saying, hey, how do we get from where we are today to really reaching financial independence? Which is what this is all about, right? Giving yourself that time freedom. There's a whole movement, of course, these days to talk about the FIRE community, financial independent, retire early. But without those, core principles, you're not going to be able to reach that point, whether you're doing that in real estate or in the financial markets.
Yeah. Well, I think we kind of scratched the surface, and I'm excited because I think we're going to dive back again in kind of explaining maybe more so the tacticals. I'd love to hear, we're going to, take a part 2 on this because I would really love to hear more of like how you built your business, your success and your failures for somebody who might be inspired to be in the financial world and kind of just maybe see your roadmap, because I don't think people realize, I'm going to get this wrong, age 29.
Yeah.
29. Hey, I made it to the 30 club.
Nice job. Yeah.
And it's something proud to be that, like, you know, you've hustled, no pun intended on our podcast, but you've hustled through to like have a family, set yourself up for success, build a business. And I think I really want to dive deep in that in part 2 of this. So tune in next week for part 2. And thanks for joining us on the Hustle podcast, and we'll catch you next week.
Thanks for having me, Faith.